Welcome to the second part of Sun Pharmaceutical Industries Limited analysis. In this video, I am analyzing the balance sheet of the company from 2015 till 2019. Analyzing a balance sheet, profit and loss account, cash flow statement are all very important. So let's begin our analysis. We'll begin with the equity share capital. This is the total capital raised by the company from the shareholders at face value. It will be a red flag if there is a large variation in equity share capital year on year, which we don't see from 2006 till 2019. Any increase in equity share capital means more dilution of shares, which means that more shares are issued to raise the capital. We don't see that the company has diluted its equity share capital except from March 15 to March 16. More share means less profit for each shareholder, and any decrease in the equity share capital would mean that the company has done some kind of buyback. Let us look at the return on equity or ROE. It measures the amount of profit the company has earned on the money shareholders have contributed. This includes the equity capital as well as the reserves and surplus. Return on equity should be greater than 15% or around what other peer group companies are generating. So when we look at this chart from 15 till 17, it was kind of generating on average above 15%. In 18 and 19, because the profit has dropped, the overall return on the equity or shareholders' contribution has decreased to less than 7%. So when we also look at the last 5 years average, we can also compare the current ROE with its 5 and 3 years average ROE. So that will give us an indication as to where the current ROE is. It's a red flag if there is large variations in ROE over the years, which we see kind of fluctuation at least from 17, 18 and 19. It's also a red flag if ROE is below 10% or below industry standard, or in fact below its 5 and 3 years average. So I think we see that it is below its 5 years average, at least for the current March 19 data, and it's also below the 10% that we don't want it to go. We can also look at the growth rate in ROE from 5 and 3 years back. So when we look at the growth rate in ROE, we see that there's a degrowth in the return on equity, which is not a very good sign. In terms of values, the net worth or the total shareholders' equity should be increasing over the years. So here in blue, we can see that the shareholders' total net worth is increasing, but at the same time, net profit should also increase over the period, which we kind of see till March 17 it was increasing, but in 18 and 19 the profit had dropped almost half of what it was in March 15. When both are increasing, it would indicate that the company is generating and employing its capital efficiently. And it would be a red flag if the net worth is decreasing consistently over 2 years. The net worth is consistently increasing, so that's a good sign, but in between 18 and 19 the profit had dropped, or the net profit had seen quite a substantial drop by almost 50%. Return on capital employed or ROCE. This measures the amount of EBIT, earning before interest and tax, the company has earned on the total sources of fund. Company's source of funding would be either through equity or borrowings. Return on capital employed should be greater than 15% or around what other peer group companies are generating. So here, none of the years from March 15 till March 19, company has managed to generate above 15% of capital employed. We can also compare the ROCE or latest ROCE with its 5 and 3 years average. And it's a red flag if there is a large variation in ROCE over the years. Although there is not large variation, but there's a decreasing ROCE over the years. It's also a red flag if ROCE is below 10% or below industry standard or below its 5 and 3 years average. So is by default below its 5 and 3 years average. It is also below 10%. In fact, in March 19 it fell to as low as 8.4%. Next, let us look at the values of the capital employed and the EBIT. Capital employed should be increasing over the years, which we see in the blue, that in March 15 it was around 34,000 crores of capital employed, and it increased to 51,000 in March 19. At the same time, the EBIT should also be increasing, which we don't see here. Again, from 6,000 crores, 6,900 crores in March 15, it has dropped to 4,365 crores in March 19. An increasing capital employed would suggest that the company is growing and there is demand for its product and services. That is why it is deploying more and more capital into the business. An increasing EBIT, on the other hand, would indicate that the company is generating profits and is working efficiently and may also be having the pricing power, because of which it is generating higher EBIT. But in this case, although the company has been deploying more and more capital, its earning power in terms of EBIT is decreasing. It's a red flag if the company is employing more capital but not able to generate corresponding return in terms of EBIT, which we can see it in this particular chart. So as the company deploys more capital in the business, we should be able to see more revenue being generated. But sometimes it may take a few years for profit to start rolling in after doing capital expenditure or any kind of expansion. So the expenses will be upfront but profits will be delayed. But then in this case, we need to look at whether the company is deploying more capital based on capital expenditure, or is it because although the company has employed is employing more capital into the business yet not able to generate EBIT. So we need to distinguish where the problem is. Next, let us look at the return on assets or ROA. Return on assets or ROA measures the amount of net profit the company has generated after taking into consideration all the assets the company has shown in its balance sheet, which includes the fixed assets, inventory, debtors, cash, work in progress, etc. So this is the total balance sheet size that we are looking at, and on that what kind of profit the company is generating. It should be as high as possible or around what other group companies are generating. We can also compare the latest ROA with its 5 and 3 years average. So we can see in the previous 3 years it was generating above 7%, which in March 19 has fallen to 4.1%. Now most of these return ratios are using the EBIT or the net profit as their base value or as their comparison value. So therefore, anyways, we earlier in the previous video of profit and loss analysis, we had seen that the company's profit had fallen in March 18 and 19. So when the profit is falling, then it affects all the ratios, which are basically profitability ratios. There's no fixed benchmark return that we can expect to put it as a benchmark, but different sectors would have different return percentages on its assets. Service sector companies are asset light, so they would have a higher ROA, whereas many companies invest heavily into assets and therefore may have low ROA. Here we can look at individual values. We should look for upward trend in the total balance sheet size. That is, the balance sheet size is increasing, and when it is increasing steadily over the years, that's a positive sign. Understanding the internal components of the assets, what is the balance sheet asset composed of, is also very important. That is, how the assets are divided proportionately into debtors, cash, investments, fixed assets, inventory, and so on. Let us look at the ROE average, which we saw earlier when we looked at individual values of each year. In the last 3 years average, ROE stood at around 10.3%, whereas 5 years average stood at 12.5%. this is still lower than the 15% benchmark that we have set for ourselves. And we can also look at what other peer group companies are generating as ROE over the 5 and 3 years period. If the current ROE is below both 5 and 3 years average, that's a sign of weakness basically. We can also look at the ROCE 5 and 3 years average values when the current ROCE value is low. Average of both the 5 and 3 years should also be above 15%. Or we can look at the industry standard where other peer group companies or what kind of returns on capital employed other group companies are generating, and we can compare our current company with the peer group companies. Low ROCE and declining ROCE over long periods would show inefficiency, which we see because from last 7 years the average ROCE was around 13.4%, which is declining now to within last 3 years the average return being generated is just 10.3%. The net worth as a percentage of total liabilities would measure how much the shareholders are contributing towards the funding of the business. So in this case, we want the net worth or money coming from shareholders to be as high as possible. We should look for above 50%, which means that 50% of the funding to the business is coming from shareholders and the balance may be through debt. And it would be a red flag if the net worth as a percentage of total liabilities is very low. In this case, we can see that it's above 50% throughout its 5 years data that we have here. And when a debt is very high, it signifies weakness in the company. We should look for a stable net worth percentages over the years, and it has always been steadily moving upwards towards 63% in March 19. We should look for a steady rise in both the total assets of the company as well as the net worth, which we see in this chart where the company's assets are also increasing as well as company's total net worth indicated in green is also increasing. Next, let us look at the borrowings or debt as a percentage of total liabilities. This would measure the amount of money the company is raising by borrowing from banks, financial institutions, etc. Now, the borrowings or the debt should not be crossing 50% of total liabilities. That is a benchmark. It can cross if there is a growth in the company, and the borrowing percentage should be stable or declining over the years. Now we can see that the borrowing percentage is very flat at 16% since last 3 years, and it has also been declining. So that's a positive sign basically. We can see here the actual debt position of the company. In March 19, the company's total debt indicated in green is around 10,000 crores of the total assets of 65,000 crores. So that's a very good percentage that the company is maintaining, around 16%. The borrowings to fund the growth of the business is good, and if it's at the low interest rate, that is also good. Borrowings reducing means that the company is paying off the debt. It would be a red flag if there is a large borrowings with high interest cost and the revenue at the same time is also falling. So that's a recipe for disaster. Next, let us look at the debt to equity ratio. This would measure the contribution of debt and the equity to the total sources of funding that the business receives. The debt to equity ratio should be less than 1, which indicates that the company's debt position, that is how much money the company has received from debt and how much from equity, is almost same if the debt to equity ratio is 1. So it should be less than 1. High growth companies may have a ratio of more than 1, but then interest coverage should be more than 4 times, which we saw earlier in the last video where we analyzed the P&L account, where it showed that the interest coverage was above 4 times. So that would indicate that the company is managing its debt at a very good interest cost. A company can have a high debt provided its product and services have demand in the market and hence able to pay the interest cost. So this is also very important to understand. In this particular case, we can see that the debt to equity ratio of March 19 was 0.25 times, meaning equity was, or rather the debt was just 0.25% of the total equity contribution. In value terms, we can see that the total equity contribution or net worth of the company is growing from 25 to 41,000 crores, whereas the debt is quite flat at around 8,900 crores to 10,500 crores. So this is what we should be looking for in our companies, and the debt should be growing slower than equity, which it is. Fundamentally, strong companies would have low debt and most of the growth would be funded through internal sources. And it would be a red flag if the debt is more than equity. Next, we'll look at the price to book value or PB ratio. This is a valuation ratio, and it basically compares the actual book value of the company. Book value is the actual value of the share, and in this case it would measure how expensive we are buying each share when we compare it with its book value. So we are comparing the actual value as per the company's records or books with the value of the share in the market, and price to book ratio should be less than 2.5 times. We can see March 15 it was quite high at 8.3 times, meaning price was very expensive compared to its actual value, which it has now declined in March 19 to 2.8, and the current 12 months PB ratio is at around 2.6, which is still high than what my benchmark is. So basically what we are doing is we are comparing the actual value as per the company's records with the value of the share in the market. When we are paying less than 2.5 times the actual value of the share, it means that we are buying at a reasonable level. Fundamentally, strong companies would normally have upwards of 2.5 times the price to book ratio, but we can also look at its 5 and 3 years price to book ratio. For example, if it's very high, if it's about 2.5 times our benchmark, then we can look where the company's price was trading since last 5 years on average or last 3 years on average. So that way we'll have a good understanding as to whether the company that we are analyzing, was it always trading at such high levels, or it's just right now it is expensive and previously it was available at a much lower valuations. So this we can compare by looking at its last 5 and 3 years average values. Here individually we can look at the market cap to the net worth. We can see the market cap has been falling consistently from 2,12,000 crores. This was the value of the company in March 15 in the market, and in the recent 12 months the value has fallen to 1,09,000 crores, whereas the net worth has although been increasing, the market cap or the price of the company in the market has been falling consistently. We can buy at a good valuation only when the market price falls. The fall could be due to sector specific reasons or company specific reasons or even general economic downturn. If the long-term fundamentals are intact, we should invest. It's a red flag if there are governance issues or management issues. We should definitely stay away from such companies. And before buying into any company, we should always research on the internet for scams or past problems related with the company we are analyzing. That's very important because in India specifically, there are many companies which have very bad governance issues, and whenever there is a governance issue which comes up in the media, the stock prices just plummet down, just fall down very fast. So we have to be very careful with that. Let's look at the current ratio. This is the liquidity ratio. Basically what it does is it measures the company's ability to pay or service its current liabilities using the current assets. Now what is current means? Current means that those liabilities which the company has to pay in the current year. So current ratio should be more than 1 times, which would then signify that the company has enough current assets to pay off those current liabilities. Here, in most of the years, the company's current ratio has always been above 1. In March 19, it was 2.5 times, meaning assets were 2.5 times higher than the liability it had to pay. So it has a good liquidity position, and this is what we are looking for. Companies may resort to borrowing funds if its current liabilities exceed the current assets, and that would increase its debt and as well as payout in terms of interest. Basically, it creates more pressure on its working capital requirement. Here we can see the assets to liabilities comparison. The company's assets indicated in blue have been at around 31,000 crores to 34,000 crores in March 19, whereas the liabilities were quite low at around 13,000 in March 19. So we can see that assets are large enough to pay off these liabilities which may arise in March 20 or March 19. Next, we'll look at the net block percentage. This is the fixed assets or net fixed assets after depreciation. So basically what we are trying to understand with this graph is how much assets the company has when compared to its total balance sheet size. So net block as a percentage of total assets would measure how much the fixed assets the company owns when compared to its total assets. This fixed assets would generally be like machinery or plant, building, etc. That is after deducting the depreciation. And the net block should not exceed 40% of the total balance sheet size. So in this case, we can see in all the years it has never exceeded 40%, although it has been steadily rising now in March 19 to 33%. A lot of money, if it is blocked into assets, basically it signifies that the company is capital intensive in nature, and that they would be incurring heavy investments into fixed assets. The net block percentage should be also stable over the years. If you look at the amount of money the company is investing in fixed assets, so we see it's quite stable at least till March 18, and in March 19 the company is invested heavily into either doing some expansion or some kind of growth or capital investments. We can see here in this graph that the total assets in March 19 were around 65,000 crores. Of that, the total assets the company owns in terms of fixed assets after deducting depreciation or after considering the depreciation, it is around 21,000 crores. So that is a 31 or 32% of the total assets. Assets owned by the company should increase gradually, so that it signifies that there is a systematic growth in the business. We don't want a haphazard or large variation in the assets. Acquisition of any other business may also increase the net fixed assets, because when the company goes for acquisition, they may get a lot of assets from the other company. Next, we'll look at the capital work in progress percentage as a percentage of total assets. Now, this is the cost the company has incurred on fixed assets, but these are still under construction, so they cannot be shown under fixed assets. So the separate category is created for capital work in progress. This should be less than 20%, because if a very high percentage of work is going on into the business, then basically the money is stuck into that particular asset for 3 years till it starts contributing to the profits of the company. A high capital work in progress would basically indicate that the company is expanding or there is growth in the business. So in this chart we see that the total capital or the amount of work in progress in terms of capital nature work in progress is around 1,400 crores out of the total assets of the company. So this is quite low, and this should not form a large portion or a major portion of the total assets. If the current work in progress is high, we should check if there is growth in sales over the years. If not, it may be a potential red flag, because the company may invest a large sum of money into fixed assets, but if this corresponding growth in sales is not there, or the company is not able to generate revenue, that will basically affect its net profit or basically overall performance of the company. Next, we'll look at the investment percentage. This would again compare the total assets the company owns with the amount of money that was invested. So this basically would measure the portion of the total balance sheet which is under the investment activity. Investment basically should not form a large percentage of total assets, and it should be below 20%. Investment activity generates additional income for the business, but it should not be a very high percentage. We can see that from 15 to 17 it was declining, but in 18 and 19 the company has put in a lot of surplus cash into investment activity, and it's generating other income for the business. Unused cash can also be invested to generate other income. Value wise, we can look at the total investment all of a sudden has increased from around 1000 crores to 7000 crores. In fact, in 19 also the company invested a big chunk in under investment activity out of the total assets. Now we need to ask a question as to why so much money is being invested. Is there no growth in the company? Why the company, or maybe the company has received excess cash and that is why it has put it under investment activity, and whenever it requires it may put it under it may use it for investing activity. This investment is basically investment in shares and mutual funds. Next, let's look at the inventory percentage. This is the amount of finished goods or goods used in the production and held by the company. Inventory acts as a buffer basically between the manufacturing and the order fulfillment. So inventory percentage should not be more than 20%, because we don't want the company to be carrying a lot of inventory, and a very high inventory basically carries with it a risk. The risk is of goods becoming obsolete, or increase in the cost of warehousing, loss due to theft, fire, etc. So here in this case we see that the company's inventory holding has been quite stable between 12 and 11%. Here we see in this chart where the company's total assets in March 19 were 65,000 crores. The inventory holding was around 7,886 crores. The value of the inventory should increase gradually over the years, and there should be some consistency in the amount of inventory the company is holding over the years. There should not be abrupt increase or decrease in inventory holding. Next, we'll look at the debtors percentage, or the amount of accounts receivable from customers to whom the company has to collect payment from for goods and services which are sold on credit. So basically debtors should not exceed 30% of the total balance sheet size. Here in almost all of these years, the debtors as a percentage of total assets have never increased above 15%. A high debtors percentage would generally mean that the company is not efficiently collecting payment from its customers, and a high debtor percentage may also mean that the company is giving high credit days to its customers to pay back. So here in this chart we see indicated in green the amount of money to be collected from customers in March 19 was 8,884 crores out of the total assets of 65,000 crores. It would be considered a red flag if debtors start growing at a very fast rate over the years. So we see kind of a stability or basically not a very high variation in the amount of debtors. As the total assets are growing, the debtors will also grow, but they are growing at a nominal pace. Now in this chart we are looking at sales to debtors, whereas in the previous one we looked at debtors to total assets. Here this is also known as sales turnover or debtors turnover. So here in this particular chart what we are trying to understand is the amount of debtors or accounts receivable still pending to be collected against the sales of a particular year. So sales to debtors percentage should be less than 30%. Here we see that in March 19 it has crossed my benchmark of 30%, where it means that the amount of payment we collected from customers was 31% of the sales. So anything above 30% is doubtful and needs to be looked into. An increasing ratio would basically mean that the company is selling more goods on credit, and that may be a cause of because of subdued demand. In this chart, we can look at the sales to debtor values individually, whereas in March 19, the total sales done was around 29,000 crores. Of that, in the balance sheet, 8,800 crores was still pending to be collected from the customers. Then that's around 31% of the 2019's sales value. So collection from customers should be done efficiently as the sales increases. As a percentage of sales, it should be collected firmly and quickly. Here in this chart, we are looking at debtor days or collection days. This is the number of days the company is taking to collect payment from its customers. Faster collection days is positive, as that means that the company is receiving money faster or quickly from its customers. The debtor days should be less than 90 days or 3 months, and that's my benchmark. It's a red flag if debtor days exceeds 90 days. Here in both March 18 and 19, we can see that the debtor days or collection days have increased to 108 days, and in March 19 to 112 days. And in the previous 3 years, it was within the 90-day period of our benchmark. So here what happens is, when the number of collection days goes up, it puts stress on the working capital requirement. We should look for the number of days that other companies are also giving to their customers to pay, and that way we can understand whether it's an overall industry trend or it's specific to this particular company. Anything above 90 days of customer credit needs to be investigated as to why the company needs to give such high credit days to its customers. Payment when not received from the customers on time puts a lot of pressure on the working capital requirements. Individually, we can calculate the debtor days by dividing the debtors with sales and then multiplying that by 365. So here in March 19, we can see the same value of 30,000 crores of sales and 8,884 crores of payments still to be collected. Inventory turnover, this particular ratio measures the multiple between the sales and the inventory holding. The higher the inventory turnover, the better it is. So when a low inventory turnover therefore would mean that the company is holding high inventory compared to what it is selling in a particular year. So here in March 19, we can see that the inventory turnover multiple was 3.7 times, which means that although the sales was 30,000 crores, the company's inventory holding for March 19 was around 7,800 crores. So that's a 3.7 times multiple between sales and inventory. We want the inventory holding to be increasing gradually as the sales increases. As in the case of debtors, we saw that as the sales increases, the debtors would also increase, but then it has to be at a gradual pace. So this concludes our analysis of the balance sheet for Sun Pharmaceutical Industries, and in the next chart we'll look at the cash flow statement analysis as well as the quarterly profit and loss account. Thank you for watching this video.